It's literally never been easier to get into the stock market. I mean, you can open a demat account on your phone in minutes, right? With just a few taps, you're buying shares, mutual funds, gold, the whole shebang. It feels like you've just been handed a golden ticket. But here is the harsh reality. Despite how incredibly easy it is to start, the vast majority of beginners in India actually end up destroying their wealth. So, why does this happen?
Well, 93%. Just let that number sink in for a second. This isn't just some random guess. This is a staggering statistic straight from a recent SEBI study. 93% of retail traders lost money in futures and options between FY22 and FY24. And we're not talking about pocket change here. These beginner investors wiped out over 1.81 lakh crore rupees in total losses. That is a mind-blowing amount of wealth just gone.
Welcome to This Explainer. Think of me as your personal finance mentor today. We are going to navigate the Indian stock market together, and more importantly, I'm going to show you exactly how to avoid falling into these massive, wealth-destroying traps. Because honestly, most investors don't fail because the market itself is too risky. They fail because they keep making the same predictable, totally avoidable mistakes.
So, here is what we're going to cover today. We'll break down the quick profit trap, investing without research, putting everything in one place, panic selling when the market drops, and the often ignored emergency fund. Finally, we'll wrap up with the real secret to long-term wealth.
All right, let's jump right into mistake number 1, the quick profit trap.
We've all seen it. You're scrolling on Instagram or Telegram, and you see these flashy reels from unregistered finfluencers promising you can make 5,000 rupees a day or guaranteeing the next multi-bagger stock. Or maybe it's crypto FOMO. It is a complete illusion of rapid wealth. Instead of letting their money compound quietly, beginners get sucked into this hype. And hey, it's super tempting when you're just starting out.
But here's why chasing that hype is absolutely dangerous. You're looking at a huge risk of total capital loss. A lot of the time, beginners get caught in these pump and dump schemes. The influencer pumps up the stock, you buy in, they sell out at a profit, and you are literally left holding the bag. This is exactly why SEBI is cracking down so hard right now, banning these fake gurus and freezing their accounts. They're giving illegal advice that wipes out retail savings.
So, how do we fix this? First step, just mute the noise. Unfollow those hype accounts today. If you're going to take financial advice from anyone, you absolutely must verify their SEBI registration number. And honestly, the best move for a beginner is to stop chasing daily thrills and shift your focus to steady, reliable mutual funds.
Moving on to mistake number 2, investing without research.
This is such a common trap. You buy a trending stock just because your friend recommended it or a random WhatsApp group said it was going to the moon. Look, a hot tip is not an investment strategy. If you buy blindly without knowing the underlying business, you're going to panic the second the price drops because you have no idea whether you should hold on, buy more, or sell.
The solution here is super simple. Before you invest a single rupee, run through this basic checklist. Can you explain what the company does in just one sentence? Do you know exactly how they make their money? And are their profits actually growing over time? If you can't answer those questions, walk away. You really need to invest in understanding the business, not just buying a ticker symbol.
Okay, mistake number 3, putting everything in one place.
Now, the finance world calls this poor asset allocation, but let's just call it what it is, putting all your eggs in one basket. Imagine building a portfolio with only IT stocks or only railway stocks. Sure, when that sector is booming, everyone feels like a genius. But if that specific industry crashes, your entire net worth tanks right along with it. It leaves you completely vulnerable.
You have to protect yourself by diversifying. Spread your money across different sectors and different assets entirely, like stocks, gold, and debt. And if trying to balance all that manually sounds like a headache, just use mutual funds. Apps like Crore make it incredibly easy to buy into diversified funds where professional managers do all the heavy lifting and spread that risk out for you. It gives you built-in stability.
Which brings us to mistake number 4, panic selling when markets drop.
Picture this. The market takes a dive. Your zero-to portfolio is suddenly flashing red, and panic sets in. The most common beginner reaction is to stop their SIPs, their systematic investment plans. It is so tempting to just hit pause during a scary event, like the 2020 COVID crash, just so you stop seeing those paper losses. But history tells us time and time again that panic is temporary, and the market usually recovers way faster than we expect.
I want you to really think about this number, 16.8 lakh rupees. Data tracking investors over a 20-year period showed one person who just kept their 10,000 rupee monthly SIP running no matter what. Another person got scared during some volatility and paused their SIP for just 3 years before restarting. That little fear-driven pause, it cost them a massive 16.8 lakh rupee deficit in their final wealth compared to the person who just stayed the course.
The takeaway here is golden. Time in the market always beats timing the market. You've got to train your brain to see market corrections as a massive sale, a buying opportunity, not a reason to run for the hills. Consistency is going to outperform fear every single time. Whatever you do, don't break that compounding chain.
Mistake number 5. Overlooking your emergency fund.
Honestly, this is probably the most ignored advice out there. So many beginners jump headfirst into the stock market without building a safety net first. But what happens if you face a sudden medical emergency or a job loss? If you don't have cash on hand, your SIPs bounce, you get hit with bank penalties, and worse, you are forced to sell your stocks to pay your rent, often locking in terrible losses if the market happens to be down. Your investment portfolio is not your emergency piggy bank.
So before you invest even a single rupee in the market, meticulously build a dedicated emergency fund. Tally up your basic monthly living expenses, multiply that by 3 to 6 months, and put that cash into a totally separate, easily accessible savings account or liquid mutual fund. That buffer is the exact thing that gives you the peace of mind to let your equity investments grow untouched for decades.
And finally, Section 6, the actual secret to long-term wealth. Now that we know exactly which traps to avoid, let's tie it all together. When you look at the growth of a continuous 10,000 rupee SIP over 10, 15, and 20 years, you see the pure mathematical superpower of compounding. The growth absolutely explodes in those later years. Your early, disciplined investments create this massive foundation that all your future wealth is built on. It's not magic, guys. It's just time and math working quietly for you as long as you stay out of your own way. And the data backs this up. Maintaining steady SIPs across different fund categories like large cap, mid cap, or tax-saving ELSS funds consistently delivers really strong growth over a 10-year horizon. You do not need to stress about picking that one perfect golden stock to get rich. You just need to broadly participate in the growth of the Indian economy through diversified funds.
I want to leave you with this core mantra, something I want you to remember every time you open your portfolio. Successful investing is not about quick profits, it's about avoiding mistakes and staying consistent. Discipline is literally your greatest asset. So looking at your own habits right now, what is the one single step you are going to take today to fix your portfolio and protect your financial future? Think about it. Thanks for hanging out with me on this explainer, and I'll catch you next time.